What's going on? Welcome to my channel. I am the covered call guy, and my YouTube journey, my goal here is to create $120,000 in annual passive income. I am currently holding 6 covered call ETFs. My projected annual dividend slash distribution income is about $70,000 a year. That translates to about 5.8K a month, 1.3K a week, $191 per day, and about $7.99 per hour. Legal disclaimer before I start this video: this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice. Because I am not a licensed financial advisor, investment professional, or tax expert, all opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, guys, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, let's get started on today's video. It's gonna be my deep dive on WPAY to TOPW. Yes, you've heard that right. RoundHill is finally, well, they made a post saying we're concerned, and yes, we heard your concerns, and we're changing entirely. We're pretty much dissolving WPAY and creating a new ticker symbol, TOPW, to replace WPAY. All right, so we're gonna be doing a full breakdown. This is my analysis. I could be wrong again. So let me know what information I might have got wrong. But all right, we're gonna be talking about the risk mechanics, volatility decay, and mega cap leverage. Pretty much what they're changing and what is new about this new ticker, right? What's pretty much what are they changing? So, all right. I want everybody here, especially for those who are new, that found my channel, new subscribers, new to the income space, to listen very carefully, because again, Wall Street is manufacturing a lot of complex derivative strategies to pump out yield, right? If you don't understand how they get this yield, right, you're gonna get lost. You're gonna end up getting liquidated, pretty much, right? So I'm gonna be brutally breaking down RoundHill's weekly pay evolution. No corporate fluff, just the math. You guys know I have no sponsor. I say how it is. I try to be as truthful, right? So, are you ready to see how Wall Street manufactures yield? Hopefully, this video breaks it down. All right, so this is the brutal evolution of pretty much RoundHill WPAY, right? WPAY failed its original stress test. So on March 20th, 2026, they're ripping out the guts of the flagship fund and starting over. They are abandoning their original methodology. Why? All right, so what is the WeeklyPay trademark, right? I broke it into 2 sections. Hopefully I'm right. The first one is bridging the gap. So most covered call ETFs, I would say, right, I made a video on this, are traps, right? Capping your upside just to harvest premium. Daily resets, that's gamblers' trash, right? For the most part. WeeklyPay seeks to bridge the gap, right? Uncapped 1.2x leverage upside to single underlying assets with weekly cash payouts. The second part is the restructuring. What they're doing is WPAY is officially dead. They're about to just wrap it up and make a new ticker and leverage ETF out of it. Enter TOPW. That's what they're naming. That's gonna be a new ticker symbol, right? They're moving to a concentrated, modified market cap basket, right? They're claiming it's for stability. But is it, right? We got to always ask yourself, is it, or is it damage control? Let's rip the math apart, right? At the end of the day, it is still a leverage ETF. What really changed? Okay, equal weighting stupidity, right? WPAY originally is equal weighted everything. The stupidity behind this, I think they mix stable mega caps with absolute crypto chaos. They held equal weights in hyper volatile crypto proxies like MicroStrategy, Coinbase, and Robinhood. The reality is a 5% allocation to MicroStrategy completely destroys your portfolio variance compared to 5% in Microsoft, right? Equal weighting a basket of leverage derivative creates severe drag, and we've seen it. They couldn't handle it, right? The monthly friction trap, right? Versus the transactional drag. Rebalancing active swaps every 30 days is a trap, right? You bleed money on spreads, broker fees, and swap costs. It is pure invisible NAV erosion. The second is momentum penalty, right? Equal weighting is anti-momentum, right? You literally sell the outperforming Max 7 every month to buy mean reverting secondary stocks. It is mathematical suicide. The math behind it did not work, no matter how pretty they try to make it. This, all right, so pretty much this all combined created extreme variance plus monthly friction, which led to severe NAV erosion, right? Period. Math. Right, the reality of beta slippage, right? So a 2.23% permanent loss. What I mean by this is volatility decay will break you. If an index dropped 10%, then rebounds 11.11%, it's back to $100. That's a zero return. Okay, with a 2x daily reset, well, you drop 20% to $80. You gain 22%. You end at 97.77. You just lost 2.23% while the underlying asset did absolutely nothing. Again, this is mathematically guaranteed in sideways markets. All right, let's look at my mathematical formula, right? So DK pretty much is how it's breaking down. Variance times leverage squared minus leverage. DK is exponential, oh God, I'm keep messing this up. Exponentially sensitive to your leverage multiplier and underlying volatility. Don't let anyone tell you otherwise, okay? I talked multiple times about this. When it comes to leverage, it only wins in one condition, and that is with the market slowly ticking up every single day. In a sideways or a downward market, right, low volatility market, you will get hammered. Okay, high leverage plus high volatility equals your money evaporates. That's just the math behind it. It's simple math. I can't explain it any more simpler than that. All right, so the weekly reset shield. So what are they doing, right? A different duration. So TOPW targets a 1.2x of the calendar week total return. Friday close to Friday close. Killing intra-week chop. You stop the algorithmic garbage of buying high and selling low every volatile day. Conservative leverage. 1.2x create a mathematically tiny drag coefficient compared to a 2x or 3x fund. The catch is that weekly resets don't eliminate drag entirely if the stock is volatile across multiple weeks, okay? Understand this part here. Even though they're making these changes, resets alone aren't enough, right? What is the only real solution then? Well, here comes the architectural overhaul, right? WPAY garbage equal holding is gone, right? Now this is the TOPW. They are ripping out the guts and starting over. Here is the pivot to quality, right? They dumped crypto for monopolies. So exposure is now exclusively the top 25 constitutes of the so active GBS US 500 index. They eliminated speculative momentum entirely to stop the bleeding. They pivoted to global monopolistic tech and defensive stalwarts. Okay, let's look at the exact companies saving this fund. Part 1, right? NVIDIA, Apple, Microsoft, Amazon, Alphabet, Class A and Class C, Broadcom, Meta, right? These are deeply entrenched microeconomic monopolies. Part 2, Tesla, Eli Lilly, JP Morgan, Berkshire, Exxon, Johnson Johnson, Walmart, Visa, and Micron, right? They traded pure chaos for fortress balance sheets. Part 3, Costco, MasterCard, ABBV, Netflix, PG, Home Depot, GE, Caterpillar, right? This is the only way to survive leverage long term. They have to buy global assets, okay? They have to buy global monopolies. This is the only way. Mathematical impact of this, well, systematic resets only, right? So now we are transitioning from high beta, idiosyncratic risk, which is single holding, like what they did with Palantir, to broad systematic market risk, something like Apple, right? These assets trade on a global macro trend, not localized sentiment. And then part 2 of that is compressing variance, right? Applying a 1.2x weekly resets to the 25 largest monopolies radically compresses baseline variance. The result we should be seeing is mathematically minimal beta slippage. Okay, so what exactly and why exactly do these mega caps suppress volatility so well? Well, you guessed it, right? Mega caps have structurally lower volatility due to systematic liquidity saturation. That means passive index flows, right? SPY and VU blindly create continuous demand, stabilizing pricing. Corporate buybacks, right? Apple, Microsoft deploy hundreds of billions. This is a massive structural floor. Options market depth, right? Deep derivatives ecosystem prevent the violent price dislocation seen in a lot of small caps. So what is the ultimate nightmare scenario does this suppression prevent? Right? That is killing the 83% risk, right? 100% wipe out risk. The math of leverage, look at this, simply put, a $100 investment at 1.2x equals $120 exposure. If it drops 83.33%, you lose all $100. Your equity base is wiped out. So with crypto stocks, this was an actual real threat. With Apple, the probability of an 83% drop in 5 days is practically zero, okay? Unless something pops off like nukes. All right. Other than that, practically zero. All right. Market circuit breakers trip at 20% anyway, so you pretty much stop there. Right. The catastrophic liquidation tail risk has been functionally eliminated, not completely, functionally eliminated. Two very different things here. Okay. Weighing mechanics. Right. Modified market caps. Well, pure market cap weighing lets 3 tech stock run the whole fund. TOPW use a modified cap, right? So if a stock gets too big, its XF weight is algorithmically chopped and redistributed. Diversification enforced, equal weight penalty resolved. So this is how they're trying to do. That's what I got from the I guess their perspectives, their little, pretty much what they were putting out on the link at Reddit, and this is how I think they're breaking it down. Okay, and we probably won't really know until it actually gets put out. So, all right, and then you ask yourself for this one is, well, if they're doing this, all right, how do we stop bleeding money on transaction fees? Okay, quarterly rebalancing, right? The schedule. So rebalancing drops from monthly to quarterly. This is executed on the third Friday of March, June, September, and December. All right, triple witching, right? This aligns with option expiration for immense liquidity and cheap execution, and then letting the winners run. This was another huge issue that people were complaining about, right? So they stopped trimming the winners, right? We ride the momentum, transaction costs slashed by 2/3. Now you got to ask yourself, what about the hidden costs behind the scenes? Well, derivative architecture, right? No cover calls. We want uncapped upside. So they use a total return swap, right, with global banks to get the 1.2x exposure. This is the dirty secret, though. Dealers charge massive spreads to hedge volatile trash like Palantir, right? I'm not saying Palantir is trash itself, but it's very volatile in that way. Hedging Apple is cheap, right? The financing drag is now materially lower. Okay, costs are down, but what about the actual yield? Where does it come from, right? That's a question I always ask on my channel. Where does the yield come from? Well, Volatility Risk Premium, right? Your expected return is pretty much risk free plus equity premium plus volatility premium, right? Yield isn't magic. It's the Volatility Risk Premium, right? They applied a 1.2x exposure and distribute the expected return weekly. Remember, guys, though, this isn't organic income. It's your future return paid to you today. So basically, TOPW, right, temporarily transforming the equity risk premium. Okay, they're kind of, all right, this is what we're expecting in the future. We'll give it to you today, but that doesn't mean it will keep happening like that. Okay, and let's talk about the truth about rock, right? It's expected to be 100% return of capital, right? Again, these are not corporate dividends, right? They are liquidating your capital appreciation and handing it to you as cash. It is expected to be 100% rock. What that means, rock does help reduce your cost basis. Buy at $40, get $5 in rock. Basis $35, right? You defer taxes until you sell. Rock lowers your cost basis, deferring taxes until you sell, and pretty much, let you worry about it in the future. And if you're old enough, you might not have to even worry about it. Okay, synthetic dividends, right? Traditional investing, sit around and wait for quarterly payouts. WeeklyPay, algorithmically transform capital appreciation into continuous synthetic yield. So instead of compounding passively, a portion is systematically ripped out and handed to you, right? High frequency income without capping the upside. Okay, this is a total transformation of traditional equity ownership. Okay, we gotta talk about the bad though, right? The ugly. bear market death spiral, okay? Mitigating NAV depletion. So listen to me very carefully on this. I stressed this the last time with WPAY. If the market crashes, a 1.2x leverage amplifies it, right? If the fund keeps paying you cash while the market burns, they are going to cannibalize your principal at a very high rate. As NAV shrinks, your capital base drops. A compounding downward death spiral. Moving a fortress balance sheet was an absolute survival necessity, but it does not stop the bleeding when there is a bear market. And then you can ask yourself now, well, then why buy this, right? How does TOPW stack up against the competition? Well, if you look at TOPW versus the ecosystem, right? You look at cover calls, upside strictly capped. You look at daily 2x, 3x leverage, severe beta slippage. You look at the passive S&P, right? 0.0% fee, unleveraged. You look at TOPW, 1.2x, and it's weekly, right? Uncapped leverage upside. I'm brutally honest here, risk-free, you might as well buy SPY. TOPW charges a 0.99% and carries counterparty risk. This is strictly for bullish investors wanting amplify exposures. So what is the big picture here, right? What does it tell you? This is where you look at this and be like, okay, what judgment can I form here, and what decisions can I get out of this? Okay, institutional retail, right? This is the paradigm shift, the democratization of complex derivatives. You now have access to strategies previously gatekept by Wall Street institutions. That's what's being offered here, right? And hedge fund tech, right? This is what you're buying, right? Synthetic yield generation, option overlay, and volatility capture, right? So once strictly for hedge funds, now pretty much packaged into highly liquid ETFs for retail for you, okay? Leverage and derivatives are no longer exclusive. They're basically giving you out like it's candy. Everybody gets a piece if you want it. Okay, my final verdict though, okay, is TOPW actually better? I'm gonna give you the brutal truth here. No, don't flame me if you end up, wanting to buy it. If you own WPAY, you're switching over. Is it better? Yes. The old WPAY was a mathematical garbage file. You just admit that here, right? It wasn't gonna work out. Equal weighting crypto proxies with monthly rebalance was guaranteed to bleed your NAV dry. A short prolonged bear market would have just completely destroyed it. You're seeing this, right? So by bolting 1.2x leverage exclusively to global monopolies, they stopped playing Russian roulette, right? It is structurally superior. But don't get this twisted, please. Just because I'm saying it is better, right? Don't think it is a good hold or buy. Because if the market tanks, right, your loss are magnified and that yield will cannibalize your principal. It went from guaranteed death spiral to highly aggressive weapon. Better? Yes. Safe? Still a heck no. Now you can ask yourself, now you know this, I'm giving you at least what I'm seeing, what I broke down. Are you buying? Right? That's the real question is, are you buying? Right? Hope this video is informational, creative, funny. You got something out of it. Maybe you didn't know this was happening and you just, I didn't really care about WPAY or TOPW or RoundHill's, but this was a good piece of video. If it was, smash that like button, subscribe, comment, leave me a like. Let me know in the comments if you're buying TOPW or staying away. I don't hold back on the truth on this channel. You guys know this. So subscribe for more deep dives. I do my best to give you brutal, honest, okay, unfiltered videos. I say what I gotta say. I do not have any sponsors again, okay? I know some people are asking, well, why you make certain videos like this? I don't have any sponsors, nor do I really care about getting sponsors. That would really kind of hold me back, and I don't like being held back. Obviously, I'm in my early 30s trying to reach financial freedom, right? So, I want to be free. I'm going to take the chains off myself, and, I'm pretty much trying to take the chains off you guys. So, thanks for watching. Thanks for supporting. Thanks for subscribing. And I love you guys. Love you all. I mean that. Stay tuned. Catch you guys on the next.